have to read this little disclaimer. I must let you know that the information on this webinar is intended for the confidential use of clients and prospects of CalTRUST. It is not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited. Comments made by the speakers are their opinions and not that of their respective firms, State Street or CalTRUST, and the comments do not constitute investment advice or analytical research and should not be relied upon as such. And we are recording this on December 19th at 10 a.m. Pacific time.
Great, thank you, Will. Good morning, everyone. Thank you for joining us today. As most of you know, I am Laura Labanieh, your CalTRUST Chief Executive Officer. This is our last webinar of the year, and we thought, I know it's a tough time of year to get people. We appreciate everyone joining us this morning, but we thought this would be a really opportune time to touch base and have this conversation with having our election last month and then the last Fed meeting of the year this week. So today we're really going to have just a conversational post-election reflection with myself. Many of you know Will Goldthwait, who's on the line. He's a VP Portfolio Strategist with State Street Global Advisors. And then we have Elliot Hentov with us, and he is the head of macro policy research with State Street Global Advisors. So please make this conversational, use the chat box, use the Q&A, ask us questions. Let us know what's on your mind, and we're just gonna chat a little bit about what is going on with our world right now, because whoever knows what's going on with our world, but we thought this would be great. So I'm gonna go ahead and hand it over to Will and let you kick us off this morning.
Super. Thanks, Laura. Good to be here. Yeah, we definitely want to make this conversational. And I'm going to hand it over to Elliot, but sort of tee up this idea that we are really in a funny environment, one in which there is real political change going on, and there's been a real shift in how certain parties are sort of moving away from what we've considered as norms. and also a shift in sort of a global trade environment. Mercantilism is a word that's being thrown around of late. This conversation is meant to be very dynamic. We're not going to sort of follow a script. Elliot and I had chatted beforehand and really like the idea of just being able to sort of talk about the things that we think are most relevant. So I'll pass it over to Elliot. He'll give some comments, and then we'll just sort of try to engage in a question and answer. And of course, for those on the line, please use the chat function or indicate to us however you want to ask your question. We'd love to get questions. So Elliot, I'll pass it over to you.
Thanks, Will, and thanks, Laura. Thanks for having me. Just briefly for everybody, and again, do welcome comments. Usually I'd come in with a nice slide deck and I'd overwhelm you all with an incredible amount of data and charts and convince you that this is the way things are going to play out for certain in the next quarter, and that's how you should be positioned accordingly. I'm not doing that today. We're having a discussion partially because if you really step back, a lot of the things we're thinking about are genuinely uncertain. And just think about the last 24 hours alone, the amount of surprises we've had from different policy vectors. So my team looks particularly at a variety of policy drivers that go not only central banking, but we look a lot at fiscal, we look at trade policy, of course, industrial policy, and geopolitics, and we really try to figure out, where do markets stand vis-a-vis what we think will happen. And there's obviously, I want to summarize this. It's post-US election. It's not the only thing that matters, but it is the main thing that matters because US policy is going to shift in a lot of different ways. Some are obvious, obviously on the trade front, on migration and so forth. Some are a little bit less obvious with regards to fiscal. But a lot of it matters in terms of it's not enough to know, okay, great, there'll be some US tariffs. No, what matters is also the scope, the timing, and the magnitude of when these roll out, because some can have kind of a tailwind and some can be a headwind for markets. So we have four issues to think about, mainly the US policy shift, but then there's also three things happening outside of the US. They matter a little bit less, particularly to US dollar investors, but the fiscal plans in Europe to a degree, because that can be a source of global demand. The Chinese response in particular, that's probably where we have the biggest delta in terms of what global supply demand conditions could look like. And then, of course, finally, the wars and to what degree how the wars play out in the Middle East and Europe matters too. So let's start briefly about the US. So obviously, if you think about, there's 4 big uncertainties that we have: trade, fiscal, migration, i.e. or AKA the labor market, and the 4th is kind of the pro-growth agenda that could come from deregulation and some more administrative changes in government. I think the big question for investors is not what's coming. We know there'll be more tariffs. We know that the fiscal will stay loose, may become a little bit looser even. We know that migration will be curbed, and we know that deregulation is going to be growth and business friendly. But that doesn't tell you enough, because as I mentioned before, the question is which medicine will be administered when and how much. And so if you get basically the growth negative stuff first before you get the growth positive stuff, well, that's actually going to create a very different trajectory than the other way around. So maybe just to start off with, just because we had the last 24 hours, we obviously saw the Fed decision. The Fed decision was partially the teacher raising his stick in the classroom and saying, I see you, Will, in the back row. I see you. You're thinking about doing some nonsense, but I'm aware of it. It was one way to say, hey, we've looked at, not only is the economy relatively robust right now, we even see some potential for some inflationary revival, but we're also not idiots. We are aware that fiscal policy and other governmental policy could actually be driving inflation too. The same thing what happened yesterday was fiscal, which is that you basically had the chief consigliere to the Dawn blow up the U.S. budget, which was supposed to, we hadn't had a proper U.S. budget in 2 years, but there was supposed to at least be a continuing resolution, kind of keeping things as on, punting it into kind of the early part of next year, and Musk and co basically blew that up, even though it had kind of been already a stitched up deal. The reason this all matters is less the theatrics, but the question is, our assumption has been that fiscal stays loose and gets a little bit looser. But even to do that, you have to manage the process. And the question is whether actually the Republicans, with a majority of basically 2 seats going into next year, will actually have the discipline, the party discipline, to get that through the finish line. One thing's clear: you're not going to get any fiscal relief or stimulus beyond what we have until the second half of next year. I think that should be clear now. You'll get some type of improv in the early parts of the year, but the big fiscal package, the extension of the Trump tax cuts and so forth, will come the second half of the year. So kind of a growth tailwind from fiscal, not until second half of the year. So what's the timing on the trade front? There, I had lunch with trade experts in the Trump circle before the election. Actually, the individual who authored the 2018 tariffs, and he said, we're ready to go. This time we know exactly the product specifications, the trade codes. We know exactly which tools. There's different tools depending on sections of U.S. commercial law that you can choose. That basically one is kind of an anti-dumping. We don't have to go into the details, but basically there's a legal process to follow. You basically classify it, then it goes through a review period, and then it gets enacted. And this time, that we're not going to wait a year and a half. The Trump administration knows exactly what they want to do, particularly on China. On the others, I think there's still a lot of leeway. So you're going to get tariffs in the first half of next year. The question really is the magnitude and the scope and the pace of rollout. So what does that mean for inflation? Well, tariffs are not inflationary if the price levels adjust. You get the tariff, prices go up once, and then eventually the tariff's there, and that's kind of the new normal, and you basically get prices behaving according to supply and demand thereafter. So it's a temporary supply shock, or a one-time supply shock. typically the Fed should look through that. The risk is, and I was talking to Will earlier, the really risk on the tariff side is less that you get tariffs, but just you get a variety of tariffs imposed in kind of a cascading function. And so what would that look like? Hey, China, we're going to lift you 10% tariffs in April. If by July or August you do the following things, or don't do the following things, we'll add another 10%. In the meantime, we're negotiating with Europe. Hey, Europe, you'll get 5% tariff in May. And if you don't do anything what we want by September, there'll be another 5%, and so forth. And so what you could have, the market hostile scenarios where you get a cascading set of tariffs coming in every few months or every quarter. In that respect, that would somewhat be inflationary, because you're getting a lot of price level adjustments happening over and over again. And that can kind of set off a little bit of spiral of inflation expectations and so forth. Plus, that is going to be harmful to growth before the growth positive things happen.
Yeah, Elliot, I just want to emphasize that for the listeners so that they understand. So a tariff, if you impose a tariff, as you just said, it's a one-time price change. So the cost of something goes up by 20 or 30%. Businesses then there's the new price. So that their input or output, and then they're managing that new price. But I think you brought up a really interesting point, because this does feel as though it is a strategy with this administration to say, hey, we're going to put a tariff on whatever, and we expect you to do this. And if you don't, we're going to put more of a tariff on. And I think that's this price uncertainty, which is the thing that's plagued the previous administration, right? Is this instability of price. So I just think that really a one-time tariff with no follow-on repercussions could make sense for the economy, but sort of this looming threat of escalation is the part that could create real uncertainty with folks and prices and be a destabilizing factor in the economy.
And again, back to the Fed, it makes their job much harder. And I partially read the signal yesterday as kind of like, if you're going to deliver more inflationary impetus, we, the Fed, have to respond in advance, because we have to manage inflation expectations and people's forward pricing movements. And you're right. I think the worst case scenario is you get this constant threat and uncertainty. Businesses don't like uncertainty of the tariffs. Tariffs themselves are not such a bad thing for a relatively large closed economy like the US. They are a tax increase, but the tax is not distributed. Some of it is borne by US consumers, some of it is borne by US distributors, but some of it is also borne by foreign producers, and that's partially the target. And some of it's borne by exchange rates, meaning the purchasing power of overall economies shifts. And in this case, this would be dollar positive, so the purchasing power of Americans gets boosted a little bit, partially offset by higher prices. But it's a tax increase, and it's a one-time thing. And by the way, tax increases never are inflationary. That is simply not the case. They deliver kind of one-time adjustments. But a cascade of rolling price increases, that is a different story. We've never had that. But that is the risk that you end up there, because you use it as a political weapon. Obviously, Mexico, Canada is a great example. There will be no tariffs on Mexico and Canada, I'm willing to bet, all of 2025. But the headlines around it will come back again and again. And that leads me to the real worry that I have inflation-wise for next year is on the labor market, because you are going to get migration curves. And the migration curves will be meaningful, less on the deportation side and more on the net inflow. Obviously, this is a Californian audience, so California is very much acutely responsive to kind of migration flows from a labor market perspective, particularly sectoral, relatively unskilled services, construction, leisure, hospitality. That's where a lot of the migrant labor, I was going to say migrates to, but obviously lands and concentrates there. And I just really want to make everybody aware the issue is less deportations, although those will rise. A rough benchmark is Biden was deporting about 250,000 people a year during his administration. Obama range was, I think, somewhere between 400,000 and 500,000. So there's certainly scope for the number of deportations to rise by at least 200,000-300,000. I think that's eminently feasible. It could even be higher, but 200,000 to 300,000, I would imagine. Most of those are what we would call, they're active in the labor force. But the bigger impact will be on net migration. Since the pandemic ended in 2021, the overwhelming majority of US labor force growth, the majority has come from immigrant labor. And that immigrant labor, we think we could come down almost as close to zero in terms of actual making a contribution to labor force growth, meaning we think the migration curves could be so dramatic that migrant labor will just basically come in the amount that matches Americans exiting the labor force. And that obviously will have big implications on the labor market, not immediately, but over time. And therefore, you have to then assume AI and automation and robotics pick up to the point where you don't get a sustained rise in wage pressure.
Ellie, can I just ask a clarifying question? So you said the Biden administration was deporting about 250K, Obama administration somewhere between 400 and 500, and then you thought this administration might be deporting 200K more than...
Well, 200K more than today. So I'm saying there's no reason why they cannot go back to Obama administration levels of deportations.
Okay,
So
got
double
it.
current levels.
Yeah, that's what I heard. Okay, cool. I just wanted to clarify that it wasn't on top of the Obama, so like 600-700, because that. And then, as far as immigration, it feels as though Trump was listening, and there was some rhetoric that he that was attributable to him talking about, bringing in skilled legal immigration for businesses across, various industries. Do you think he's walking? I mean, I know he's got a strong, opinion on this as far as how he, spoke about it to get elected. Do you think he might soften on that as far as allowing legal immigration to help those businesses that have those hard to fill jobs? We know that there's a lot of hard to fill jobs. Do you think there's any truth to that?
I'm skeptical just because we had Trump 1.0, in which the first acts were to curb legal migration and curb it quite successfully. So the sector, even though there was a clamoring among sectors for more visa issuance, that fell on deaf ears, and I think the problem is that it's an easy KPI for the administration to say, hey, we got elected on a platform. You cannot be blind to the fact that immigration was a major part of the electoral appeal and the result. And they want to deliver and show. And so I think one of the KPIs is to bring net immigration down. You reduce legal migration routes. And I think certainly in year one, you're going to actually get a drop in that, despite some sectors clamoring for more. There could be a little bit more company-specific favoritism in the migration process. I think we should be realistic here that there could be some favoritism that's now channeled through government forces. So I don't know if anybody saw the news yesterday that Tim Cook had dinner at Mar-a-Lago on Tuesday night, and the result afterwards was that basically, yes, Trump understands that Apple cannot compete with Samsung, so tariffs would have to exclude Apple products, and I think there could be a lot of that also on the visa front, where you basically have people who have access to the administration are able to get carve-outs from what would otherwise be the restrictive migration policy. And again, Marcy put in the chat for everybody that it's really about the net migration more than the deportations. To give you a figure, just rough benchmarks is net immigration during the Biden administration years was somewhere annually from 21 to 23 was about 2.5 to 3 million people a year net. That's dropped a lot this year as migration curves have kicked in, but you're still kind of in the high, somewhere 1.75 million people net immigrants. So obviously, deportations of an extra 250,000 is nothing compared to the potential of a reduction of 6 to 100,000 to 1 million net immigrants. That's obviously a much bigger factor. And again, what matters is it meaningful enough to shift the marginal demand for labor that suddenly, boops, you get the click, and wage pressures that have stabilized in the 4% range, even in the unskilled service sector, suddenly start to tick up, because that's something the Fed will be eagle-eyed on.
Yeah, and that could be a real spark to inflation, right? Because we know that those folks, at the hourly wage level, any additional dollars in their pocket, they're spending. And that can be a real driver of demand, and ultimately create the spiral. What about also, I just was reading an article, the boomers continue to retire. I guess the last of the baby boomers is sort of in that peak retirement age, somewhere between 60, 65 years, and creating a real labor shortage, particularly in some of the skilled jobs. Do you think the administration is considering just, overall demographics when it comes to the immigration policies? Again, I definitely heard you loud and clear and completely agree that there's going to be exceptions. And those companies that are able to influence immigration for their company's favor, should be able to get it. But what do you think about the overall demographics in this country and the fact that the boomers are leaving the workforce?
Well, it's clearly showing up. I think one of the challenges has been, I mean, we're entering 2025. It's almost the 5-year anniversary of the pandemic. The pandemic coincided with the peak of the demographic retirement wave. Then you had a rise in asset prices, both home and equity, and that kind of facilitated higher retirement rates than usual. I do not think the demographic issue is. My impression, having spent time a little bit with kind of the campaigns, is that they're particularly alert to the demographic issue. I think the Biden administration was sensitive in late 21 and early 22, and basically actively facilitated above average immigration. Obviously, there was a electoral consequence to that choice. That was an active political choice to do so, because they were recognizing wages had risen a lot. There was a labor shortage, and you basically needed immigrants to fill the gap. I don't think the flip side is the case with the incoming administration. I think there's a big belief that AI and technological productivity gains can find a way out. Moreover, my impression really is, and I spend time obviously with the more intellectual side of the administration, in terms of these are a lot of ex-academics or current academics, and their thinking really is ideologically that, hey, actually, we want to achieve a labor shortage. That is actually the goal. That is the goal of the tariffs. Subsidize production here, restrict migration, create a labor squeeze so that businesses either have a choice, hire American labor and pay them more, or invest in machines and processes that make you more productive so that you're more competitive. So the labor shortage is a positive byproduct and an enabler for the economic change they want to see. And there's obviously there is a sound rationale to that, although that is, again, that can mean you have inflation as a byproduct during those years, and it can also mean you can have supply side constraints on growth. So there's a cost to that. That's not cost-free. That's not a smooth process, but there is a logic inherent to that.
That's pretty interesting. So you could potentially see huge investment, and then ultimately major productivity gains. I mean, there's been so much hype on AI all year long, and all the investment going into that to actually have businesses, have their feet held to the fire, so to speak, and then have to actually make these changes because the cost of labor has risen so much. And also just this idea of recreating the middle class, right? Not recreating, growing the middle class, and bringing back those high skilled, high paying jobs that have been sort of pushed outside the country. Very, very interesting.
I think one problem I have with all of this is that I like it too because there's a sound logic. The problem is that if you look where AI and these productivity gains are, they're not in the sectors with labor shortage. They're in sectors that are kind of where the labor market is very in a healthy balance. It's mid-skilled and upper skill. It's surprising. It's one of the first technologies that's really targeting partially upper skilled roles. And so therefore my worry is you get productivity gains. That's great. We'll all bank them. But then you have kind of this skills mismatch in the economy where you're missing kind of the folks in front of Home Depot that my wife's Californian. So it's like you miss kind of visually, those are the people you're missing. And what you have is then you have a whole bunch of like paralegals and lawyers and accountants who are suddenly have to retrain and figure out where can they apply their skills with the same income level. And I want to warn people, we had something like this happen not too long ago, and it was quite painful. What we had is after the GFC, after Lehman, we had the U.S. housing imploded. You had a lot of surplus of construction workers, and you had U.S. manufacturing kind of suffering the China effect. And so you had a lot of manufacturing workers and construction workers, kind of from an income perspective, close to middle income, lower middle income workers. They all had to migrate to places where there were jobs, which was lower service sector, hospitality, restaurants, that type of thing, warehousing, where they got paid less, was a less skills intensive job. And that was not good for all of us. As an economy, it meant actually lower productivity economy wide. And so you could basically, if you think about it, if you push some higher qualified people out of their roles because of AI today, they have to migrate to less productive roles somewhere else. Yes, you get a productivity gain in the sectors, and from an investing point of view, that's very attractive. But from where I sit as a macroeconomist, I want the right workers in the right place at the right time, and that jigsaw puzzles kind of would be harder to achieve. So you could actually have situations where you have surplus labor in one area, shortage in other. So you get wage pressure, but you also get unemployment. And so that's kind of what we had for a while, a little bit in the 2010s, where we had kind of pockets of wage increases with a large pool of untapped labor too.
And ironically led to sort of the political disruption that we're experiencing now, right? So how ironic if we got disrupted again for the exact opposite reason that what was intended.
Well, I think the other interesting thing is this strategy of focusing on the AI and technology really puts a high reliance on the AI and technology being able to grow at that pace. I mean, when we've had discussions about it before, yes, AI is coming, it's the big buzzword right now, but it's going to be a decade before we really see it. Because even now, where I think we see a lot of AI, there are still humans behind it checking it because the technology is so new. So I think that's another really interesting part, is if there's that reliance, like how long does that actually take to become efficient? And if you push it, then how badly does that actually end up backfiring in the end of technologies being pushed through quicker than prudently because of these demands? So it's really interesting.
Yeah, Laura, that's a good question. I can tell you the one upside is, even if you don't get the productivity gain, you could still get a growth bump. And you'll get a growth bump because everybody, as you say, everybody's rushing in, everybody's trying to do it, which means that money, CapEx, is flowing in a big way into. I think one of the, again, Will knows me. I sometimes, unfortunately, I'm not the party pooper, but I do have to think of all sides of the equation. Is the problem with CapEx in this case is that a lot of it is flowing into actual hardware, and so a lot of that hardware is not made in the U.S. And so basically it runs up the import bill, which obviously exacerbates kind of the hunger and appetite for tariffs and trade disruption. And so you basically, it's not like the CapEx doesn't flow to hiring, just giving, moving people around or using US resources more efficiently. That will come at some point once, as you say, once we know how to use it, once the error ratio goes down, once it's kind of, we figure out how to optimize it and so forth. But the good news is GDP grows. When in eras of higher capex, GDP grows at higher rates, and that's, I think, for a bunch of treasurers, I think that's really the main message I want to leave here, is that growth should be higher, should continue to be higher. We can have a cyclical downturn, but the potential growth rate, what's the U.S. potential, has risen. It's also both in real terms, but also in nominal terms, because the new kind of inflation baseline, the neutral rate, has risen as well. And so therefore, everything should be a little bit higher. I know we've had like this decade and a half post financial crisis where we're traumatized with low rates and everything, but we are in a different world. And I think I won a big bet yesterday, which was that the 10-year would hit 450 before it hits 440. And I made that bet when the 10-year was at 415. And and the reality is, because it doesn't mean we can't have cyclical softening periods, but structurally, if growth is at least 2, maybe 2.25, and then you think inflation's at least baseline 2.5, well, where does that leave you with nominal GDP and where roughly the 10-year should be landing? I have to pause briefly just because my battery's blinking. I just need to get a cable. So maybe, Will, you can just a short intermezzo of 20 seconds.
Yeah, no worries. So I think that's a really good point, and you heard it yesterday in Chair Powell's comments, right? And the Q&A that we sent out last night, Laura, really hit on that. First of all, Chair Powell just saying the economy's strong, and he's expecting that next year it's going to be strong, I thought was a real change certainly from what we heard in September. That was super dovish, coupled with a 50 basis point cut. And so now we've gone and had 2 more subsequent cuts of 25 each, a total of 100 basis points of cuts. And now it's quite possible that we could be on hold for certainly January, March, May. Maybe we don't see another 25 basis point cut until June. Our house view, our chief economist Modica still thinks 3 cuts would be appropriate for 2025. The Fed's dots has it at 2, and the market right now is pricing just 1. So it's, I think that the amount of uncertainty as to the outcomes, I've been doing this for 30 years, and I can't think of a time when people were so mixed on what potential outcomes in the economy, in employment, in inflation could be. And I think that's the part that I find most interesting about this period, is we really are in sort of a new dynamic, and the Fed realizing that they can't make monetary policy around things that are uncertain, like what are the tariffs going to look like, are then going to tread cautiously. I loved his quote, where he says, you slow down when you're driving in the fog, and you don't rush into a dark room full of furniture. You take things a bit at a time. And I think I really appreciate this data dependency and moving only as the data presents itself. I think that's just something that we all need to take advantage of, that we all need to take note of. And then from a positioning standpoint, we've been opportunistically buying duration. We've been opportunistically keeping the liquidity pool long in anticipation of policy rate cuts. But the conversation has started to shift a little bit, and we are starting to wonder if we should be moving duration more towards a neutral stance, with the expectation that if things do grow, if labor force remains tight, if some inflation pressures resume, then does that mean the Fed actually is on hold, maybe indefinitely, or even potentially raise rates? He was asked the question, does he think the Fed could raise rates? And he said he certainly doesn't rule anything out, Chair Powell said. It's not their base case, but certainly doesn't rule anything out.
Yeah, and historically, the warning here is that if it is a soft landing, and so absent a recession, rate cuts do follow the last rate hikes follow the last rate cut fairly swiftly. So certainly well under a year from the last rate cut to the next rate hike, absent a recession. So history would be on Powell's side here to be very cautious about it. I think just to echo Will's point, one of the real challenges is a lot of this, it's because we're also having a political transition, there is a lot of uncertainty, and there's ways for policy to disrupt the path of markets or the economy to a degree that, again, I think much more than there's been the case for many, many years. So that's something to still consider. Will, should we maybe just talk about one or two things ex-US that could change kind of the global risk premia and risk sentiment?
Yeah, I just want to make sure. So we definitely talked about trade, we talked about fiscal, we talked about immigration. You talked about the pro-growth deregulation. Did we hit on that? I think there's a lot of folks that are wondering about this Doge group and what they might do. I can't.
So
yeah,
the Doge and the deregulation are somewhat contradictory, because Doge in name proclaims kind of a tighter fiscal stance, whereas a lot of the deregulation, so kind of a growth negative stance versus the growth positive stuff that comes from loosening the costs of doing business or encouraging higher capex and investment. So the deregulatory side, in some sectors it's easy to achieve, but the benefits flow mainly into shareholders. I mean, that's been on our equity side, our positioning for the election worked well from a sectoral perspective. Financials did wonderfully because finance is one highly regulated industry, and just by changing regulatory requirements, you can free up, just think of capital ratios, capital requirements for banks. Small tweaks can have a very different impact on ROEs. But from a macro perspective, for that to transmit into higher growth takes quite some time. So again, that's not something that would really show up in GDP for most of 2025, even if it shows up in the bottom lines of some shareholders. The other problem with Doge, of course, is that, again, that growth, if you're cutting spending, you are cutting demand somewhere, and that means that reduced demand has to show up as a cost somewhere. I think the most exposed is healthcare, frankly, because that is where we spend as a country over 20% or 20% of GDP is in healthcare. Over half of that is government financed. I forgot what the figure of the 20 is, about the 12-13% is government financed. That's where you can find it, particularly probably in Medicaid, a little bit in Medicare. And so where's that money going? Well, it's going right now to either inefficient delivery of healthcare services or outsized profits of healthcare providers or somewhere in the value chain. And that could be cut. And so obviously that would be good for the economy overall, but that would be to some degree, from a GDP perspective, a smaller GDP outturn.
Mm-hmm.
So that growth agenda is amorphous and takes time. That's basically the long story short. Yes, I do believe deregulation helps growth. The costs, by the way, there's a cost and negative externalities. Sorry to speak in such mumbo jumbo of my economist speak, but loosening environmental rules doesn't mean the problems go away. It just means that the environmental costs sit somewhere else. Finance, loosening regulatory standards on finance doesn't mean the risks of financial accidents has changed. It just means that the cost will be borne somewhere else. So there is a cost to doing those things, but they are certainly growth positive in the near term, but more like 2026.
Yep, got it. That's great. Yeah, happy to move on. I mean, I think I know we're talking to California treasurers, but I think the geopolitical side, the international side, is always a concern. And so happy to touch on some of the things there too, Elliot.
Yeah, I think it matters in the ability. I know as for this audience, the dollar and the exchange rate may not matter that much. But why it does matter indirectly is because why is the dollar strong? The dollar is strong because capital is flowing to the US. Why is capital flowing to the US? Because US equities have delivered huge outperformance, and because US rates are high. And so you have to think, or not only higher, but also higher than elsewhere and growing in differential. Now, the rest of the world has some ability to shape their future too. And if they shape their future in a way that suddenly pulls capital out, okay, fine, the exchange rate doesn't make a difference, but less demand for US financial assets would change some of the equation here as well. I mean, Will, you know this even better yourself in the kind of the treasury market. And so where in the world could we see a change? Well, the biggest candidate is China, because China obviously is not going to sit there passively and just take it. They're going to react, and there's two ways they could react. One, it would be negative, also for the U.S. There's no question, but in that they say, "Hey, you're harming us. You're punching. We can punch back, and the way they'll do it is not by tariffs, but by export controls on the supply side." Laura and us were chatting earlier about one of her recent product purchases on Amazon. We still are heavily reliant on China in a variety of fields. And, yes, some consumer goods I don't think the US would be too sad about if it was harder to get. But it's not only rare earths, it's particularly the processing and the refining of a lot of key metals that are essential for a variety of industrial production. And the Chinese have shown and flexed their muscles again and again to show that they can do that. And so you basically they have the ability to create minor supply shocks across different supply chains. And I think the probability of them doing it is not low. A year and a half ago, they did it on obscure metals called gallium, germanium. They did it a year ago on graphite, refined and processed graphite. And so that's a way to trigger inflation and also constrain supply. The positive thing, and this is really the upside story, because I have to put in some happy upside stories into our chat today, is they respond and say, "Oh my God, Trump 2.0 means we're relying so much on exports. Our property sector is moribund, it's dead. There's not enough infrastructure to build anymore, to invest in. So we've relied on exports, but that cannot work much longer because not only is the US hitting us with tariffs, it's squeezing the Mexicans to kind of get us out of the Mexican market. It's doing a deal with the Europeans, and probably one of the deals with the Europeans will be kind of, okay, fine, buy more American goods, but also hit the Chinese harder." And so what do they respond? They say, "Well, we're actually a wealthy country from a balance sheet perspective. We have the government has a net asset position, the country has a net asset position. We actually have funds to deploy. Why don't we plow that back into our own economy?" And they do that. They boost domestic demand. And then we have a very different global economy. Suddenly the Chinese savings ratio drops. They import more. Their type of imports are different. It stimulates Europe. Emerging markets do better. And that has a whole knock-on effect also back to the US, because suddenly the rate differential doesn't look as dramatic and the growth outlook doesn't look as dramatic with the US. And so you get capital starting to flow out of the US market. And to some degree, that would also be keep pressure higher up on US yields. Now that's the that's kind of the happy story to some degree. I don't think it's the likely one, but that is a potential outcome. It would also lessen the tensions because of the nature of the Chinese rebalancing.
Yeah, I'm. That seems like a pretty big cultural leap too. But if there's an economy that could do it, I would imagine Xi Jinping could influence, certainly, just given the controls that they have. Instructing all good Chinese folks to go out and spend, spend, spend. Um, but it brings up another point about China on the whole, and just knowing that that economy right now is struggling, knowing that the housing market they've lost all confidence in that housing market, and the capacity that was built is just too much. Sorry, the housing stock that was created is just too much. The demand's not there. Do you think that how do you think that fits into their current condition?
I think it makes it really it it makes it difficult for them because they had relied property was one of their growth engines. It's dead,
Yeah,
and now the question is it's almost like I don't know what the analogy is, but if you like a plane engine, if you have two, or let's say you have two engines, one falls out, well then the plane's like the pilot's like, okay, I'm using just the one engine that's left. I'm certainly going to just try to get this plane to its destination as fast as I can. I think the economic policymakers in China are thinking the same way. Oh God, property engine is dead. Well, now I just let's make sure the engines that we know work well, and that's what they've done. They've doubled down on industrial production and exports in the last five
yeah,
years.
yeah,
We thought briefly in 2017, 18, oh great, Chinese current account is shrinking. There's some normalization. No, far from it. They've doubled down. They've like gone in extra subsidies, kicked out foreign competition. There's an enormous excess oversupply of Chinese goods that's floating around looking for a home. And that's, I think, because they're like, okay, that's the engine we know how that works. And you'd think in a dictatorship it would be easier to change course, but it's looking like it's quite hard because they've had this model that worked so well for 40 years. And now you're basically going to say, you know what? We need new winners and losers here. And, all these people with this in the industries and that have enjoyed subsidies and so forth, that's going to end now. And we're going to basically tax a little bit more and distribute it to households so that they can spend more and buy more. Well, that creates a lot of winners and losers. And the losers, my guess in this case, are ones that have had 40 years of establishing a very tight-knit linkage to the Communist Party, to the Communist Party elites. And so it looks like clearly it's very hard to disentangle. By the way,
yeah,
the Chinese know exactly what to do. They've written papers on this about reforms. Basically, these are all reforms to lower Chinese savings, kind of pension reform so that people's retirements are higher. They don't have to save themselves as much. Healthcare reforms so that they don't have to. It's a little bit like the U.S. uninsured market where a lot of Chinese save kind of rainy day. What if something happens to me and I need a big medical treatment? Well, you do a healthcare reform. They've had plans to have the central government subsidize local governments in a much bigger way so that local governments don't have to sell off and promote property development to cash in on money. So they know what to do. And it does surprise me the fact that everybody knows what needs to be done, but they're not doing it. Suggests to me that it's actually quite hard to do because the losers are saying, no, I have this gravy train and I do not want to get off of it
yeah,
anytime soon.
yeah,
But again, that gravy train ends also if the whole world is hitting you with tariffs or just simply not going to trade with you in key areas. Well, then you may be faced with no choice, and that pushes you over the edge.
yeah. I know we're sort of bumping up on time here, Elliot. Let's shift to Europe. What are your thoughts with regard to Europe? Yeah,
Yeah, I mean, look, the U.S. is running deficits of 6 to 7%. it has a debt. The federal government has a debt ratio of over 100% of GDP, and markets have been okay. And to be honest, let's be very honest, I know it is California, the home of technology, but a large chunk of U.S. growth is simply the fact that the U.S. has been spending a lot of money, and it's been juicing the economy, and it's worked. Well, the Germans are the opposite. They have a deficit that's basically a budget that's near balance. They have a constitutional debt rule that limits kind of budget deficits to 0.5%, so to speak, in normal times. And their debt ratio is around 60% of GDP. They have a lot of fiscal space. I mean, they could be spending. I mean, think about it. They just to equalize at a U.S. level, they could be spending 10% of GDP a year for 5 years, and then they gradually approach U.S. indebtedness. So there's a lot of fiscal. Obviously, the Germans are not going to spend 10% of GDP. It's not going to happen. But my point here is, you could they'll have elections in February. They're going to spend a little bit more. I don't think it'll be enough, but there's a lot of space. Europe is not a poor place. Europe is a stagnant place. It's a very different story. It's a wealthy, stagnant area of the world. And so the question is, it's not only money that they have to throw at the problem, they also have to change how their economies are run and governed. And again, they also know what needs to be done. Mario Draghi published a big report earlier this year in which he basically says, hey, we're like old and stale. We need to innovate, we need to invest, and we need to deregulate. Actually, could have been the Republican platform, to be honest.
Yeah.
It was an EU paper. I think the politics don't let them. I think my personal view is, on the German election, because of the coalitions, you basically don't get a majority for the big shift. You get a majority for a small shift. They expand their deficit by about 1% of GDP. What is that? $50 billion. That's nice. It's a nice to have. It doesn't change the course of history as a result. But we could be surprised. You never know. Look, the U.S. election was a surprise with how the popular vote and the electoral college worked out. In the German system, you could have a strange. I don't want to bore people with German politics, but if a lot of small parties fall under a certain threshold, suddenly the big parties get a much bigger majority, and so you could have a surprise where suddenly, hey, the Conservative Party wins the majority on its own. Then you get a big fiscal expansion. Then you get a rise in the euro. Then you get also a lot of money reallocating out of U.S. treasuries into euro bonds, because suddenly that will be much more attractive. So that is possible. Again, not my base case.
Laura, I know we're bumping up on time. I want to maybe just take a pause to see if there's any other questions that have come in. I don't see any in the chat, but if folks did have questions, I want to make sure they had a minute to ask them.
Yeah, I haven't seen anything else come in. Yeah, I think this has been fascinating. I think I've taken 4 pages of notes just listening.
I know,
right
I've taken a lot too.
But we'll definitely give it a minute to see if anybody wants to hop in here with anything else. It's just a lot. It's a lot going on in the world.
Well, it is interesting, Elliot, I've learned a ton here. And, I can say that watching sort of the last 4 months take shape, and you can start to see something emerge, but there still are so many uncertainties and so many outcomes that it's still unknown, and so many risks. I think this sort of movement to create these insular economies through tariffs and Trump trying to reshape the Republican Party and regrow the middle class is fascinating, and how it comes out, it will be very interesting to see. So I'm so curious, and I hope we do another one of these, maybe in the first half or something, and see what further progress we've had.
What's another interesting thing too is, we're looking at all this change and these new platforms, when we think about an election and new presidents coming in, we have 4 years, right? Their platform. That's not a lot of time.
Hmm.
We've seen how quickly 4 years goes. So it'll be really interesting to see kind of the timeline and when things really are rolled out, how long it takes effectiveness, how long it takes to feel that, and then we're going to be back at another election before we know it. It's always something that fascinates me every time we have a turnover. We do have a couple questions coming in the chat. Chuck's asking, what is the Fed balance rate for the end of 2025? And then Marcy's asking, how hard is it going to be to reduce the deficit? So let's start with these are questions.
So our house
Will,
call.
you can take the rate call.
Yeah.
Yeah. Our house call is that the Fed funds rate will be 3.5, 3.75 by the end of 2025. The Fed thinks it'll be 3.75 to 4. They only have two 25 base point cuts pulled in there. And like I said at the top of the call, the market is expecting only one rate cut. Now the market always overreacts. So I think the bottom line is, Chuck, the bottom line is that the Fed will be moving much more slowly in the first half of the year and waiting to see how some of these policy initiatives take shape, and then see how the economy reacts to it. And what was the second one, Laura?
The deficit.
Oh, yeah.
Deficit question. I'll take that. The answer is it's very hard to reduce the deficit meaningfully. Everybody knows the bulk of it is healthcare, Social Security, and defense, and the residual is tiny. So it's very, very hard to reduce the deficit, absent some major reforms. That said, the U.S. is a very wealthy country. It's not politically, but it would be economically very easy to increase revenues and taxation. But the spending side is constrained because the bulk of the growth is tied up in entitlements and in defense. And the entitlement part, the one area that's where you can make some meaningful cuts is in healthcare. But even that, I think, is politically quite dicey. And to Laura's point, the Trump people that I've spoken to, they all say we have 20 months when we come to office. Like, they understand they will lose the midterms. I mean, they have a majority. They lost, by the way, they were a net loser in the House in November. Everybody forgets they lost a total of -1 House seats. So the House was already very tight. They know that they will lose the House come November 2026. So it's really a very short period to enact things. I think the real question on the deficit is, do you get any deficit expansion? That's the real question in my mind. And when, how much, how big? I think the appointments of Bessent and a few others tell me that the deficit will be relatively well behaved. They're actually looking for offsets. But the U.S. is running already the largest deficit in a non-recession peacetime economy. It's running the largest primary deficit, so deficit before interest payments. So even if you strip out the fact, okay, it's higher rates that are causing a deficit, you strip that out, it's still running the highest primary deficit in non-recession peacetime. So something eventually, you have to, back to Will's point and Laura's, there's a lot going on. What I would leave treasurers with, the main point is you have a much more fragile bond market that is sensitive to things, because you're already running high deficits and because there's a lot of policy variables that can shift. Maybe that's my closing statement there.
That's a good place to leave it.
I like it. All right. Well, we are at time. Will, did you have any other final words?
No, it's been a great 1 hour. I appreciate folks being on. I wish everyone a safe and happy holidays, and looking forward to talking with you in 2025.
Yes, Elliot, Will, thank you so much for joining us. I really enjoyed these discussions. Everyone, thank you for spending part of your morning with us. We really appreciate it. And again, I echo Will's sentiments. Wish everyone a wonderful holiday season. And our next webinar will be our Coffee with CalTRUST at the end of January next year. We'll be sending out the information on that here pretty soon. And that one will be great because we'll also have Simona Makuta from State Street on doing an economic update. So I think that one will be a really fun one. I always love hearing her talk as well. So with that, thank you, everyone. Happy holidays and have a great day. Thanks.
Thanks, everybody. See you later.